G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here with Chris Bates from the Alcove Mortgage Specialist. G'day, Chris. How's your week been?
Going well, Pete. Actually, going on holidays in 6 hours' time. You can see that I'm looking forward to it by that statement. But driving up to the Gold Coast. I'm not sure whether we should have jumped on a plane, to be honest. I think I underestimated the traffic going to be tonight and tomorrow. So, we're just crossing our fingers. I think the Hexham Bridge up near Newcastle is a bit of a bottleneck. So, wish us luck, Pete. What are you up to over Easter?
It's pretty busy already on the Sunshine Coast. It's interesting. People are sort of they're going out to the shops and then mucking themselves safe from the car parks and so on. It's a bit chaotic. I think you've got the timing good because we had the cyclone and then a number of weeks of terrible weather, but that seems to have cleared through now. It might just be a bit cooler, but hopefully you got some sunshine ahead for the Easter break. And then actually there's quite a lot of disruption anyway over the next few weeks. We've got Easter, Anzac Day, and then obviously the federal election is another sort of big disruptor, not just for the housing market, just for life in general. We're in a funny sort of a period for the economy and property, and loads of people coming up the coast, I've noticed. Maybe not so many people heading to the US these days.
Yeah, I was in the office this week and it was quiet around North Sydney this week. And I think a lot of people were a bit smarter than me and actually took another 4 days off this week and got themselves, a full 2 weeks off with only taking 7 days off. So, shout out to all those smart ones. But, what's a lot of stuff happening this for you at the moment with work, Pete? It's a really bit of a quiet time, Easter, Anzac, election. And then we're already kind of going to the second weekend in May. You might list your property on the election day. And, what's your take on it? And then the RBA cuts probably 2-3 weeks later, which you might want to sort of list your property after that, rather than before, just because the confidence could be high if there is some, significant cuts.
Yeah, well, we've got, a relatively quiet 2 or 3 weeks ahead, but we've had stacks of people book in for after Easter. We're basically at full capacity after Easter. So I don't know if that's driven by potential interest rate cuts or a lack of stock out there, probably a bit of both. It's always interesting when you talk about market pricing for interest rates. In the comments, people are like, you don't know what you're talking about, rates are going to go up. And well, I'm just saying, like, this is not really opinion based, it's just market pricing. So the May interest rate or monetary policy meeting is basically a done deal. I think there's 131% chance of a cut. So basically the 25 points is locked in. There's probably about a 1 in 3 chance we get a jumbo cut, but that would actually depend on the jobs figures, which are out probably, that's out Thursday morning. So by the time this goes to air, those numbers will be out, but particularly inflation data, I would say, unless there's an absolute shock to the downside, the Reserve Bank's going to be quite conservative in its moves. It will just move slowly with a bit of caution, I would think. So, but actually, if you look at index swaps pricing for December, there's actually 5 interest rate cuts priced in at this point. Now, I'm not saying that's going to happen, but we did see over the past week or two, 3 of the big 4 lenders have cut their term deposit rates quite significantly. I think NAB cut their fixed rate mortgages almost right across the board this week by up to 50 basis points, depending on the product and term. So nobody really knows where the cycle's going, but the direction of travel at least is clearly down.
Yeah, and I think, I've been taught a lesson, like probably you, Pete, to not get too fixated on what the money's saying, saying it's going to be right, because interest rate expectations have been very volatile. They've been going up and down, and even in a matter of months, it can flip dramatically. We know it's in 2022, 2023, we completely underestimated the amount of rate increases. They thought there'd be rate cuts in 24, and there wasn't, and there was actually a rate increase. And so you got to be careful looking at what the money says. Even if you go back to the Trump election and Brexit, not the recent Trump election, but I think Trump was $7. I think Brexit was $7 the day of the election, and they both won. And so the money can get it wrong. going to this election, just had a quick squiz this morning. Labor $1.20. So you would say that's a done deal, but it's hard to always 100% know the money's going to be right. But at the moment, I agree with you, Pete. It's pretty likely that multiple rate cuts are coming, and on top of the one already. And It really depends on how many and how fast they come, because property is driven all by sentiment, right? When people are optimistic, the time to buy, they're really high expectations on property price rises, and then they start missing out and that FOMO kicks in. Then the media jumps on it. We all know the conflicts of interest in the media industry. And then people start, the talk of the country starts to become about, rapidly increasing property prices. And so I think that's all we're sort of saying when we talk about this, is that sentiment is heading in that direction. And you could easily get caught out if you sort of wait for sort of, a market fall, or, try to prove the market wrong.
Yeah, well, yes. And as you say, things can change pretty quickly because we've got a fairly unpredictable president at the helm, and things can turn around rapidly. Interesting bellwether for you. My wife was just talking to Pops this week over in the UK, and he's a retired farmer from over there. So I'd say not somebody who follows the Australian housing market very closely, to say the least. But we bought him an iPad a few years ago, so he does keep up with bits and pieces of the news. And he was just saying this morning that he's been reading all about Australia's housing crisis and how much or how difficult it is to rent a home in Australia. Why is it so expensive? Why is there a shortage? And so that's, I guess, is a bit of a bellwether. He's not somebody who follows international news, but the BBC has been running pieces on Australia's rental crisis and housing crisis. So the general picture is one of just a massive undersupply of housing in Australia. In that context, we got the latest ABS figures for dwelling commencement and building activity for the December quarter this week. And frankly, the news wasn't very good. House approvals fell by 6% to housing starts fell by about 6% to about 26,000. Attached dwelling starts fell also by about 6% to around 14,000. So we're tracking about 30% below the government targets. And it looks like that building shortage, or that housing shortage, is going to get much worse before it gets better. The number of dwellings under construction are falling away quite sharply as well now. So yeah, for all of the talk about targets and pledges from various stripes of government, there's nothing really happening just yet. And I think even in the news this week, another multi-generational builder went to the wall. So that's the environment for developers. It's pretty tough out there.
Yeah, your interesting comments around the rental crisis. There has been a lot of articles around that. The Conversation, I believe, is done by, and I had a quick squiz of that. And ultimately, that's been driven by, investors have actually been entering the market, but they've been buying in areas that old investors didn't own, right? So they've been buying lots regionally, a lot lower price points, and a lot of investors have been bailing out of the capital cities, and they haven't been getting replenished with new investors. And a lot of investors have been bailing. It's very hard to get the exact numbers, but Cortality, I think it is, not CoreLogic, but they've done a great little graph over the years where they basically take X investor stock, versus the percentage of the market, and you can see over the last few years that that's been higher than the proportion of what is in that market. So let's say there's 30% of the properties are investors in that market, maybe 40 or 45% of the properties on the market are actually ex-investors. It makes sense, right? Owner-occupiers really want to keep their home, particularly under higher interest rates. They don't want to go the cost of buying in and out. They don't want to enter the rental market, so they've been sucking it up and dealing with the pain. But investors, particularly if they're feeling pressure around their home, are just going to want to bail. They can't sustain the negative cash flow, and I think we've seen that. And I just wonder though, with this end in sight, I guess, with interest rates, and if there is a say 1% cut over the next sort of 6 to 8 months, and that's how fast they could be. It's not that we're waiting 2 or 3 years for these. This is, by Christmas, 7, 8 months away, they're expecting maybe over 1% of cuts. Now that's a big, big difference for investors and their cash flow. Like instead of paying 6+%, you could be talking high 4s, right? Or 5%. And with yields going up quite a lot over the last few years, that negative cash flow is not going to be that big for investors. And so that pressure to sell, plus that pressure to sell because their home loan has dropped interest rate as well. So I think we could see tighter supply. One of the things that's actually been coming on the market over the last few years has been investors selling. So if investors stop selling, that's actually going to make listings tighter. What do you think about that, Pete? 'Cause I've just been sort of thinking about that over the last few days.
Yeah, I mean, it depends on this kind of two different sides to this argument. So the AHURI put out a report I think over the past week or so, saying how quite most rental properties are sold within the first couple of years. But I think when you actually zoom out a little bit, it's been a very, very unusual few years, and I wouldn't base too many trends on what's happened through the pandemic. But if you actually take a step back and look at what's happened over the recent sort of years and decades, well, the average holding period for a property is generally much longer than it used to be. I think we just had we've had an unprecedented shift in mortgage rates from 2% to 6% in a very short space of time for a lot of borrowers. So that smoked a lot of rental properties and landlords out onto the market. But I think things, as you said, are gradually normalizing again. I mean, it's 5 years on now from the pandemic. So I think generally with the transaction costs involved, the average capital city property now is held for about a decade, which is much longer than it used to be. So, yeah, I think, as you said, it's been a bit of a weird 2 years or 18 months, particularly, where those higher mortgage rates have forced a lot of people to sell because they couldn't stomach the holding costs and things weren't working for them, or they just rationalized the portfolio. But we're probably coming through the other side of that period now. At the moment, anyway, unemployment's still low. Finding a tenant is easy. If you buy a rental property at the moment, it'll be rented on day one typically. So if interest rates, that's the one factor that's been causing some sales. And I think those are probably just starting to come down the other side now. Maybe not enormously, but certainly it will take some of the edge off that negative carry for investors.
Yeah, particularly if you start seeing capital gains, right? Investors are going, well, do I hold off selling now for another 6 months? I reckon I can get through another 6 months, and then that just slows down supply. Then it's kind of a spiraling effect, less supply because more capital growth, and then etc. So that means you want to hold it again for 6 months, and so I think that's what we might see. I mean, I think that's absolutely the direction of our property market is. We're going to be living in homes longer and longer, not just because of stamp duty and selling costs, but just the leaps to go from one property to the next property that is a significant or material difference to what you currently own. So to go from a 2-bed apartment to a 3-bed house, that gap's bigger than ever, right? And to go from a 3-bed house to a 5-bed house with a big block on the best street, that gap's huge as well. So the ability to make these jumps is actually getting harder and harder. And the people on the bigger properties have no incentive to sort of downsize really because it's all growing tax-free. And they're getting tighter and tighter every year. We're living longer. And so I think that the time of ownership is going to keep on blowing out. And I think that'll also lead to people taking really longer term mortgages, which I think we're heading in that direction as well. Should we crack on about these election, Pete? I mean, it was pretty dire, well, pretty not much going on really with the election and property. We thought it was not much in the budget. And then bang, all of a sudden last Sunday, I think it was, my phone was lighting up as they started to announce their policies. And I actually was in a bit of shock. I was actually had the kids for the day. Probably shouldn't have been on my phone, but we're at a play centre and bang, I see the Labor policy and the coalition. And I literally was like floored a little bit. I was standing around to a few guys in the team and we were just chatting about it. Not many things shocked me because COVID, I just saw banks, governments, everyone basically do things that you didn't think were possible. I remember the payment holidays for mortgages in COVID just blew my mind. And this sort of felt like that again for me, tax deductible mortgages and 5% for everybody, basically, first home buyers are big shifts in the way that things were prior to last Sunday.
Yeah, I think the way this election seems to, well, just to clarify, we do have 3 big news stories of the week on this 2 cent segment. So let's crack through those. The first one, as Chris mentioned, is the election policies as they relate to the housing market. The way this election seems to go these days, as you said, Labour's hot favourite in the polls now. And so every time the opposition makes an announcement, it seems that within hours, there's a counter pledge from the other side. So, for example, the coalition wanted to talk about a tax cut for about half of taxpayers. And then within hours, the Labour Party announced a $1,000 tax deduction for all taxpayers on work expenses. That's just one example. In the housing market, as you mentioned, over the weekend, the coalition unveiled its plan for first home buyers to get tax deductibility on their mortgages up to 650K. And it seemed like even within a few hours, the Labour Party said, right, 5% deposit for all first home buyers from January 2026, no lender's mortgage insurance. And you do wonder, like, whether any actual modeling has been done here, or whether these are just a very quick movements to nullify any risks to the polling. So certainly that's what happened in the previous election. As part of the Labour Party policy, and don't forget they're favourites to win, so this is more likely to come in than what the coalition has announced. They're also pledging to build 100,000 homes for first home buyers only by making $10 billion of funding available. Again, look, it sounds like a lot, but 100,000 homes over 8 years is actually only about, well, 12,000 or so a year. And that's if they're actually built. So it doesn't really move the needle. Don't forget, we've had sort of 1 million extra people in 2 years. 12,000 a year is not really going to move the dial too much. I suppose there's also a question when the government starts getting involved in construction, does that sort of detract away from other new housing supply by taking land and scarce labour and materials towards government-funded projects? So as you said, the coalition has gone with one option, Labour Party's gone with another. But so traditionally, a first home buyer would need 20% deposit, maybe a bit less these days. But now Labour's saying, right, 5%, and the government basically guarantees the rest of your deposit. So, pretty interesting. And that's coming around pretty quickly, early next year.
Yeah, I mean, it's a huge change. It's absolutely. I thought that the government accessing superannuation, the Liberal government, was a big change. I thought when there was no stamp duty up to 1.5 in Sydney, a lot of people were like, oh, yeah, great news, And I was very clearly saying that's going to get factored into prices within weeks rather than, and you're going to pay more for the property. And we absolutely saw that. We saw properties should have sold for 1.3, selling for 1.5 within spaces of weeks. And the amount of demand that created, because it meant that first home buyers really only needed a 10% deposit versus a 15%. And what this policy basically means is exactly the same. You've got any income, you're a couple or you're a single, no matter what your income is, you can buy up to 1.5 million in Sydney, million roughly in Brisbane, similar in Melbourne. Like, if you can't get a good property for that, then I think you're not looking hard enough. And so what it means is that, a first home buyer, if they could borrow, let's say, 95% on 1.5 million is 1.4. So if their incomes were, say, 280 combined, or maybe even a bit lower than that, and they could basically go and buy up to 1.5 million if they've got a 5% deposit plus 5% for stamp duty. So around 150 grand. Now, a lot of people are, have got that sort of money, they've got in that, and if they've got this like now till January where they need to save that deposit, then they'll absolutely rattle the tin, particularly if they start to see momentum and rates start falling in the marketplace. And if there's a 1% of cuts by then, you could see maybe a 10 to maybe even more increase in borrowing capacity. And so that means that, and so they'll very quickly get factored into prices. I thought that was and that's maybe good if you get in early, but I think it will get factored into prices within weeks. And as soon as January comes around, but it's not great if you're trying to buy in 3-4 years time. It's really doing is pumping up prices. And, but it is a big change. It basically means that a lot of people who have been first home buyers are going to really take access to that, I think, and it'll get a much bigger uptake than it has so far, because there's really, the city limits have increased, plus the income limits have basically been abolished. So basically any first home buyer can buy it.
So it's a pull forward of demand for first home buyers into next year. It creates that distortion again between different situation for a first home buyer versus an upgrader. And then at some point it gets reversed and the distortion goes the other way. I guess that's the one thing, a 5% deposit where the government's got you back. I do worry about the housing package unveiled where the government's going to put $10 billion towards 100,000 new homes exclusively for first home buyers. But there's very, very little detail behind that. If you divide 10 billion by 100,000, by my maths, that's 100K. And you're not building anything other than a donger for 100,000. So I assume then that's a government contribution. But I always wonder, worry about people being funneled into new builds in areas where there's little scarcity. It just seems like, as we always say on these podcasts, that first step you make as onto the housing ladder, it could potentially be life changing, either for the better or the worse. And yeah, I would just say, caveat emptor, be very careful about buying something brand new or off the plan just because there's a scheme available. It doesn't mean just because you can doesn't mean you should, or whatever the phrase is. So, but as I say, there's not really much detail around that. I think it's a bit of a Hail Mary because the housing supply is nowhere near. We're about 30% below the government's targets at the moment. So they've thrown this one out there, but there's not really much texture around it. Let's take a look at this second story of the week, which almost is a fairly smooth segue. There's a development in Sydney Morning Herald this week. There was talked about $100 million mega development, or I mentioned a specific site. It's more just as a bellwether, really. Alleged to have $123 million worth of defects. And I think that, this is relevant because if government is going to try and funnel first home buyers into new builds, you do have to worry sometimes about what you're getting into. You need to be very sure that you're working with reputable and established builders. You need to have a good case for recourse. Something we talked about recently, Chris, is whether the sort of more recent developments have been of a higher standard and higher quality because they're much more so being built for and bought by owner-occupiers more so than investors. But it is a worry when you get sort of these this is an unprecedented claim over potentially thousands of defects in a development in Sydney. And this one's going right to the High Court. It's the sort of thing that would give you nightmares as a first home buyer, or in fact, any home buyer.
Yeah, look, I think you're talking a lot of properties have been built over 20 years, not just in Australia, across the world, where there's building defects and flammable cladding and leakage issues. And it goes on and on and on. When you're putting them up fast and as quick as you can in building booms, and you're trying to sell them cheap to investors, you have to basically make some small mistakes, right? And big defects can get, small defects can become big ones, right? So I think that's the issue. And we've seen a building commissioner in New South Wales, Dave Chandler, did a lot of work. I don't think he does it anymore. But these problems aren't going to go away. These buildings still exist. And I think what we're seeing as well is a lot of the Art Deco and the older apartments are getting 60 plus years old. And there are a lot of remedial work for these buildings just because, they are getting older and older. And so I think that the quality of our housing dwelling stock, not just in Australia, across the world, can often be pretty poor, particularly in a fast growing population like Australia. And I think, building quality and what we're building architecturally and the amenity is absolutely higher than what it was 5-10 years ago. I think the consumer's demanding more and more. And they're getting better and better every year. I think if you compare a 2015 build to a 2025, I think there's a big difference. However, whenever you're buying new, you are buying something that's untested to storms and cyclones and weather. And there was a client buying in the eastern suburbs just a few weeks ago. And, they were looking at a property and it was a newer build over in the eastern suburbs. I was trying to convince them to go for something a bit older, but they did love this newer build. And we ended up kind of looking at some properties and just saying, right, what about this one? And they went, and it looked like an older Art Deco that was renovated. And basically they went and looked at it. And I said, look, I'd much prefer to be buying something like this than what you're looking at. Like, it just looks anyway, they got the strata report on this and it was a dog's breakfast. And they ended up going for the new build, which, had been around for 2 or 3 years, didn't have any issues in the strata. And, it's just that sometimes, building issues do come down the line and some new builds are great, but it's so stressful, like what appeared to be a better purchase. Once you started opening up the strata report, you found some real problems. Got another client as well, which we tried to talk out of buying and off the plan on the beaches a couple of years ago. And it was meant to settle in 2 months' time. And they're very aware that we probably didn't support this purchase. And we think you could have bought something better, but ultimately they went ahead with it. And this property's been delayed another 6 months, right? And the sunset clause that's already running, and it's a big project. And so it's very, very stressful when you're buying new builds. What appears, and income changes and job changes, and borrowing capacity's changed heaps over that time. And so there's so many risks when you're buying new that people don't think about until they sign that contract. And then years later, things they keep reminding them maybe they could have just solved their problems if they bought something established with a really good strata report and a building that has been tested time and time again.
There's a good, well, there are some good lessons in there. I think, yes, there's the sort of Lindy effect idea that if something's been around for 60 years, it's probably well established and should be around for another 60. But yeah, you must get a strata report done if you're buying into those types of complexes, because you just don't know. You've got no transparency otherwise as to what's going on in the fund. The Sydney Morning Herald article concerned a project built around 2012, 2013, 300 units that cost 100 million to build, but now the defects claim is for 123 million. So, I mean, that's the sort of thing that over a dozen years would give you a lot of sleepless nights. So, yeah, definitely do your due diligence if you're going to go into something on a strata title and get a building report done or a strata report. You want to know everything that's in there in the minutes, and well-capitalized fund, ideally, no major defects or special levies coming down the pipe. So, yeah, it's a worry. And as I say, another big developer went under this week. So there's that side of things as well. Insolvencies are still high. Final story this week from Cotality. National home values rose 39% over 5 years. So that's it's an interesting sort of time period to consider, because we went through the initial lockdowns and all of that uncertainty. Then we went through a period of basically zero interest rates, and then the economy reopened, and then everybody came piling back into the country. Yes, when you look at it, most markets did very well over that period. Probably of the capital cities, Melbourne a bit less so. But it wasn't just housing prices that were up. Incomes were up very significantly. I think depending on which sector and which industry you're in. Rents also shot up all around the country after quite a long period where rents hadn't done much. And inflation's up more generally. We went out for breakfast on Gympie Terrace this week, $130. I blinked a bit before paying the bill. That's just wife and two kids and me, and only one drink each. So, I mean, those are things that are, I know it's a very specific case in point, but that's an inflation of 50% probably in 5 years. There's a lot of things that have got more expensive, not just housing. So I guess overall, we're still in an undersupply position. Median dwelling value is up $230,000 over 5 years. But as the report shows, we've had much bigger booms in the past, late 1980s, before the inflation targeting was in place. Perth has had a much bigger boom in the sort of period, September 2006, mining boom period. In fact, all of the capital cities have had bigger booms in the past. It was the 80s for Sydney and Melbourne, 2003 for Adelaide and Canberra and Brizzy, and Hobart 06, Perth 2006, Darwin 2010. So yeah, I guess a big 5 years, but not necessarily unprecedented.
Yeah, and it's like it defies belief sometimes to people looking at the property market and going, how can things get up more expensive? The price to income ratio gets worse and worse, and and you think, oh, maybe it's not going to be this type of growth going forward. And I'm unsure as well, like everyone else. You start to think, well, how could it happen? But when you see the government's introduced policies like they have on the weekend, you know that more innovation and things to keep the property Ponzi going are going to come. And so you wouldn't be surprised to see this type of growth again over the next 5 to 10 years. And maybe there's another crisis in there, and who knows what's going to happen. It seems like crises are happening more often than they were 10, 20 years ago, where it was, very consistent growth and cool down and growth and cool down. It seems like it's jumping around almost every 12 months at the moment. But who knows if we are going to see these types of growth again, because you'd say the last 5 years have been good, but that's nothing compared to the boom in the late 90s and the 80s, for example. And the Perth boom in 2006, 140% in 5 years. But you wouldn't have wanted to be in Perth for the next 15 years after that. So let's crack on with some listener Q&A. We've been doing this for a few weeks right now, and it's always a bit of a laugh at the end.
Yeah. On some of it's serious as well sometimes. So let's the first question from Raj. What's your view on investing in NDIS property. Well, gosh, this is topical. There is so much NDIS, so much in the way of projects and people participating in the scheme. Certainly where I live on the Sunshine Coast, it seems to be almost everybody's involved in one way, shape, or form. I suppose the advantages. What's the advantage of investing in an NDIS type of property investment? I mean, generally it's the higher yields, right? So if you invest in a normal residential property, what's your rental yield? Might be 2 to 3% on a house in Melbourne, or it might be maybe 4% if you're buying in another city, or maybe a bit more if you're investing in an apartment. Well, if you go into a sort of a niche asset class like NDIS, you could potentially get, who knows, a gross yield of maybe 10%, or maybe even we've seen cases where it's been higher, like 12% and things like that. But I mean, just as a general rule of investing, well, there's no free lunches. So generally speaking, if you get a high yield, whether that's on a government bond or a commercial property, that probably either represents some work that you need to put in, so it's not passive, or a higher risk. So in the case of a bond, it's a higher risk of default. I think for the NDIS, so obviously the NDIS is providing funding for these types of investments. There could be, I suppose there's a few things. It could be higher cost initially. You could potentially have much higher maintenance expenditure. So that 10 or 12% gross yield after all the costs, it might be a heck of a lot lower. I think one of the risks to watch out for is just regulatory change. I think there's going to be an appetite to rein in the NDIS spending over the years ahead as the budget blows out. And what if the rules change on it? That's one thing to watch out for. In some areas, maybe market saturation is something to watch out for as well. And I think, I mean, just by the nature of the industry, I think tenant management is going to be much more involved. I guess, Chris, my main concern when people go into sort of more niche asset classes is what's the exit plan? I think if you buy, you're talking about buying a property on the beaches or something like that, you know what the exit plan is. You hold the property and later on somebody buys it because it's an asset that's in high demand. With some of the more niche property types, I do wonder about the capital growth potential, because ultimately you're only going to be selling to potentially another investor sometime in the future.
Ultimately, a property's priced based on who wants to buy it. And that is absolutely the concern with NDIS. Yeah, you can make some money on yield, potentially. And, there's maybe a higher cost to buy it. You've got to build something with, larger doorways. I don't know all the ins and outs of what you've got to build, but often it's new. Often it's in, out fringes of the capital city where they can actually make these things stack up, in terms of the project feasibility. And ultimately, when you go and, own it and you maybe looks on paper that it's performing better from a cash flow point of view than if you invested that same amount in another property, you end up paying tax on that anyway. So all yield seems great, but it's, fully taxable. It's fully taxable income. So that could be 40, 50% tax rates, whatever you're on. So you don't, after tax, you might not be making that much more in your hand. And ultimately, when you go and sell it one day, your ability to sell it is massively restricted. And that would be my concern. And so what is the opportunity cost that you're not factoring in when you're purchasing that versus, say, maybe just buying a freestanding house in a quiet street and maybe getting a bit lower yield, but ultimately having a huge buyer pool when you want to sell it one day, whether it's an investor, first-time buyer, downsizer, family, couple. I think you've really got to think about who would you sell to. And that's the mistake that a lot of people make, A, when they're buying new builds, and B, when they're buying, things like NDIS.
Cool. Yeah, I think it's good advice. Whenever you get these incentive schemes, you do need to be a bit careful about what the end game is. Second question from D. I have a reasonable amount of equity, $1 million plus, and I would like to use my place of residence loan to invest in shares through borrowed funds. This question seems to come up a fair bit, actually. Are you able to explain the difference in debt recycling versus just increasing the size of the existing loan and splitting the increased amount to invest for tax purposes? So, Chris, I know you're sort of more across financial advisory background and borrowing strategies. What's the more common route that people go down there?
Look, I think you've got to really try to keep your debt separate because it's going to be a bit of a nightmare when you do your tax return, because you're going to say to the accountant's going to say to you, hey, what amount of that debt did you use for buying shares and what amount is actually your home loan? The home loan is non-deductible if you're living in it. and the money that you use to buy shares is deductible. So let's say your own home loans on principal and interest. Well, every time you borrow money, does your debt stay the same for the shares, or you're paying your share off and you're paying your home loan off? So just if you can't borrow any more money, i.e., basically you haven't got any servicing, but you have got some equity in your home loan, just be really careful how you do that and you do your redraw. Personally, though, what you should do is just go back to the bank, refinance your property up to 80% ideally, or go 70% if you've got heaps of equity and you want a better rate or whatever it might be. Have a separate loan split that's interest only. Put that money in the offset account. And then as you want to put money into shares, just dollar cost average out of that offset account into some a share portfolio. And you've got this separate loan split. So you've got, say, $500,000 home loan. You release $200,000 up to 70% on $1 million property, let's just call it. That $200,000 is an interest-only loan, but you put that money in the offset account, and then you start putting $10,000 a month into the investment markets. So you start paying interest every time that offset reduces on whatever you've invested. So over 12 months, you invest $120,000, and then that interest is tax deductible in your your tax return. The problem is if you just went and started taking money out of redraw, and it's all washed together, much harder for the accountant, and much harder for you to know what's deductible or not. And what you actually is debt washing, not debt recycling. And that's the real way. The problem I have with debt recycling, which I've said on this many times, is all you're doing now is equity release to buy shares. That's all you're doing. The recycling part is a fancy term financial planners have put on it so they can sell you financial advice plans. And I was an advisor, so this is not a shot at them. And what they're saying is let's say that 120 grand that you put into investment markets goes up to 150,000. They're saying sell that 150,000, pay capital gains tax, which I don't really like paying transaction costs personally. You lose 7.5 grand of that, growth. So maybe you've only got 140, let's call it. You pay off your 120 that you've just borrowed. So you've got 20 grand. Take that 20 grand, pay off your home loan, and then redraw and buy shares again. I think it's the margin you actually make in that recycling isn't as much as you think. And what you have to do is you have to buy in and out of markets. You have to pay transaction costs. Personally, if you're going to just buy the 120 grand of shares, just hold it. Just hold it for the next 10, 20 years. And don't do the recycling bit. Just do equity release and buy good assets, whether it's shares, property, commercial property, maybe Bitcoin. But don't do the recycling bit personally. I don't think it encourages the right behavior.
Good advice. Thanks, Chris. Okay, let's try and knock through 2 more of these, then we'll finish up for this week. Question from Golden Goose. I've got some money in an offset account. What happens to the offset account funds if the lender goes under or bankrupt? Will all the funds in the offset account be lost if I'm with a non-bank lender? So the Aussie government typically guarantees up to $250,000 with institutions holding ADI. So that's deposit-taking institutions. Also, what if you have over 250K in the offset account, even with an ADI non-bank or ADI bank lender? Would these funds not be covered? Look, let's just start with the banks first. I'm going to talk in general terms here only, of course. Look, I think I get this question a lot, particularly from Brits, because I remember I've got a very wealthy friend in the UK who had a whole load of money with Northern Rock, and he could see the writing on the wall. And he phoned them up to take his money out, and they said, "Oh, we'll be fine." This is what they were saying to him over the phone. He said, "Look, it's not a shot at you. I just want to spread my money around various institutions." And of course, later on, it did go under. So a lot of people got burned by that. Lehman Brothers was a whole other kettle of fish in the US. I would say, look, under Aussie banking rules as they are today, the first thing to say is it's pretty unlikely that a bank is just going to go under and you lose all your money. We've got tighter regulation for one thing, but also if you look at recent events, Credit Suisse, for example, went into some difficulties. And what you're generally likely to see, I would say these days, is mergers, takeovers. If you've got a mortgage, your debt probably gets sold on to the new institution and so on. But let's say, just for the sake of argument, if a bank did properly go under, not something we've seen in Australia anytime recently, well, you're insured up to 250,000 under the financial claims scheme. And I mean, I would say it's more likely than not that ultimately you would get any excess funds back anyway, because you're effectively a depositor. So in the capital stack, It might take some time, but you're going to get your funds back, and the mortgage would just be sold on. I think for non-banks, this question I've seen come up a few times in podcasts and webinars and things, and there never seems to be any sort of clarity around it. But just for plain English, authorized deposit taking institutions, those are your sort of big four banks, your second tier banks who are looking after people's deposits. So there's a very tight regulation around what they can and can't do. A non-bank lender doesn't necessarily have the same situation because they're not taking deposits from people. And look, I've heard instances where people have checked the small print in their documentation. It says, well, it's not an offset is not a normal bank account, so therefore it may not be covered by government guarantee. The only thing I can say here is you really have to ask your own lender and check the documentation. I don't think there's anything I can say on a podcast that's going to help too much, but you really just need to read the documentation. And if you're not sure, ask them. And I guess an obvious thing is that maybe you don't want to have over 250K in one institution if you can avoid it. But obviously in an offset, people are trying to maximize. Chris, have you come across anything on that side of things?
It's funny you mentioned Northern Rock as a flashback to the past. When I was living over in the UK, and I was 20, and I worked in funds management and accounting, even at Fitness First, to be honest, and McDonald's. And I moved to the UK and wanted to be a financial advisor, and basically did a course up in Milton Keyes for a bank called Abbey National. Exactly, the city roundabouts. And basically, I was only 20, didn't have a hair on my face, and Northern Rock was going under while we were doing our training, and people were buying shares in Northern Rock. So the advisors they regretted that, but that was a real moment for me. I think that's when I started as an advisor. I think it was into the December of 2007, and then 2008 hit in 2009, and what a year to start as an advisor. And Northern Rock, it was absolutely the start. I think banks going under. I mean, it's definitely, if you're already asking this question, you're someone who's very risk conscious and looking at all the risks out there, and you're the last person who probably needs to worry about this 250 because you probably be ahead of the game. But I think you've also got to be, it is a risk in this times in markets where, the credit crisis and the issues where banks getting themselves into trouble. But often in those situations, at the end of the day, there's usually mergers and acquisitions because the banks usually got assets on their balance sheet, when it's deposits or mortgages that they can sell. And that's often what happened. Even in the credit crisis over in the UK, a lot of businesses like Northern Rock just got cut up and sold to different banks. And deposits were fine, and the government steps in, and no government wants to see a bank go under. I mean, a funny story though, my parents actually lost money though in a bank collapse down in Victoria in the 1980s. I forget what it was. Forget the name of it. It's got a very unique name to it as well. But they were offering, I think it was like 17 or 18% interest rates, or 3 or 4% above what every other bank was offering. And literally they got cents on the dollars back from it. And all their money from a property sale had gone into that account. So it does happen, but everything's a bit different to the 1980s, I guess.
Just what we said earlier, that higher yield sometimes represents a higher risk. Last question for this week from M. Pros and cons of renting out a property to the DHA, Defence Housing Australia. So quite similar in some ways to what we just talked about before. I suppose the plus side here is you're basically getting a guaranteed rental income, and you'll never have an issue finding a tenant. And plus everything's kind of managed for you. Those are the pros. I think if you're going to go down this route, I think there's a couple of things. One is you want to still buy in an area where there's high demand for housing. You probably don't want to go out to the boondocks for something like that. Management fees can be higher. I mean, obviously everything's done for you, but the service fee on the rental income is pretty high. So 16.5%, I think, and maybe a bit less for townhouses and units, 13%. So that's generally more than you'd pay a normal property manager. I just think the other thing is, just like with NDIS, you just got to think about what's the end game, because essentially that type of property purely appeals to the investor, not so much for future home buyers. So yeah, I guess those are my thoughts on that, Chris. Just very similar to the NDIS. It's just it's more of a niche asset class, and it's more of an income focused investment. But yeah, the capital growth may not be as good as you could get elsewhere.
Yeah, I think it very much ties into our question around NDIS. I've seen clients who have absolutely been stung by the DHA type of investing before, because ultimately when they sell it one day, the market's not as big as they thought it was going to be. And there's been a huge opportunity cost as if they just bought that type of property versus other assets. And it's a common mistake, people chasing guarantee. Similar when people buying off the plan or new property and they say, oh, rent guarantees. Don't fall for the spin. Really think about what you're buying and how you're going to sell it one day.
Beautiful. Thanks, Chris. So obviously you're Gold Coasting this weekend. I think we'll be trying to get away from Noosa, maybe just head to the hinterland or something, get away from the crowds. So yeah, have a cracking weekend, everybody. And yeah, look forward to seeing you next week, Chris.
Happy Easter. Thanks for listening, everyone.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.